How much more downside do they see in something like the S&P 500, and how far do they think that we are from capitulation or some form of capitulation that would be meaningful in terms of putting money back to work?
Yeah, well, I think that the number for, if you're talking about the proper slump style '08 thing, Jeff, the insurance companies are a long way away from buying a market low here. This is whether you think that we've discounted a terminal rate, whether you think, and actually the break evens suggest you are approaching that 0.2 to 2.5, depending on which part of the curve you're on, says that the market is pricing in that terminal rate. So tick box one, potentially you can see a peak in rates. 2, year on year, you'll see inflation begin to fade. But what I think is, and it's just mathematical apart from anything else on a 12-month view. What is interesting is obviously what happened in the UK gilt market. Is it a sort of earthquake of actually the bond vigilantes are back, the government spending cannot be eternal, and it's not going to be accepted anymore. If it is going to be accepted, it's going to be at higher rates. And I think it's very interesting the last few days. I certainly think that's what's catching people's eye. It's certainly caught mine. Is you look at the insurance against sovereign bonds, you look at why bond yields are going when actually it's patently obvious that growth is fading, and it's saying something. And it's interesting to see if we can actually afford another splurge by governments to be counter-cyclical during a downturn. And that's a TBA. I don't think anyone knows the answer to that. And at the moment, the market is behaving as though it wants a higher premium for buying government debt. That therefore impacts corporate debt and follows through the food chain. So that is the challenge. That's the next shoe to drop if there is one, Jeff. And I think that's what's obsessing most people. You've seen some serious damage in growth stocks. Are they cheap enough yet? Probably not. The value stuff has run a little bit, but would you want to buy deep cyclicals at this point? Probably not. So that's what I'm hearing. I'm staying in that middle ground, which I'm afraid is the repeat I've been saying on this program for I think most of this year, which is that you go to those income-y strategies, the sort of slightly more defensive end of the marketplace. And you can start picking up, and they have been picking up a cyclical. Something like Next in the UK has been smashed to bits. It's still a great retailer. Microsoft is coming back into vogue. There's a few. I'm just picking up some stock stories.
Yeah, Peter.
And then if you're just buying LVMH. I mean, you're just sticking with what you know.
I hear what you're saying. Peter, good morning to you. And I just wanted, before you go down that list, I want to actually just go into that list. I agree with you. Some of these prices and some of these yields and some of these dividend incomes from stocks that are going to be around after the recession look amazing. They look historic, actually, as well. But is now the right time? Or should we dollar cost average? Or do we wait? Do we wait till we see the recession? Or is now a good time because the market is a forward-looking indicator?
Well, the old argument is, Steve, we're housing ourselves there for the moment. I think, why do you buy LVMH? Because the rich are still rich and they were locked up for a couple of years and they're busy going to spend, and Adidas is not LVMH. And I think that's the other interesting dynamic. There is some very stock specifics here, Steve. I think Adidas and Gucci versus LVMH. I mean, I've heard that story all week. We're doing European equity week this week particularly. And that story is writ large, and that's how you've got to differentiate. So there's a big gap emerging between companies. Even when I'm saying the income thing, I'm saying it's somewhere to hide, Steve. It's only done relatively well. I'm not sitting here advocating for it being a great idea. I thought bond yields will carry on going up. I have thought that all year. I thought it's going to be a difficult year, you know that. And the bond yield is still going up. And money supply is still going down. And in those environments, tighter money and more expensive money, I'm afraid, makes for difficult wealth assets. And have you seen a full capitulation? Last few weeks, you've certainly started seeing some decent withdrawals, and globally as well. So you're beginning to see that contraction. And then the dollar has done what it's done. And in those environments, it remains really difficult. On the other side, high yield is now over double digits in the US in terms of what you can buy as a collective pooled vehicle. You're certainly on the way in a lot of asset prices. Are you in the final mode? No, you're not. But if you fancy 10.5%, 11%, you can now get that in US high yield.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.